Because I've won on that trade already and I'm treating it as I've taken it completely off, I'm going to treat this 11-day expiration that you guys can see here as a new trade. How would I set up my collar if I was starting with this 11 days to expiration right now? I disregard what's happened before with the 3 days to go because I've already won. That's no disputing that. I've made money. Recently, we've been talking about trading the ES for the collar strategy. And because of the platforms we use, it makes it a little bit more challenging because you have to know the ins and outs of the collar strategy a lot more than you would potentially have to know it on shares, regular type of stock shares like Apple, Tesla, so forth. Because the platforms don't give you sometimes it doesn't give you the max loss, sometimes it doesn't give you the max gain, any of those type of things, so you can be able to determine what's going on with that collar. You have to provide those numbers for yourself, and that's the mechanical or the manual part of doing it. But the buying power and the leverage, the built-in leverage of using something like the ES makes it worth it big time to just learn the mechanics of it and then do it. This talk at this point is not about understanding all the basics of the ES. It's more of understanding that even if you're doing something in the ES, what happens if it goes in the money? And it'll be the same concept if it was a stock option. If you were doing a collar on shares and that option went into money, the call went into the money or the put went into the money. When you're trading a collar strategy, don't fear it. It's no problem. Everything is still good. Now let me break it down so you can understand it before I show you the dynamics on the screen here. If the call is in the money when you do the collar strategy, you have made money if you traded it the way we teach it. That is a good thing. You have made money. You have not lost money. If the put is in the money, it means the market has dropped. If you're doing it on the S&P 500, which the ES is, it means the market has dropped and you no longer losing because that put is in the money. So you can rest assured that the bleeding is over technically if that put is in the money. To me, that's two good things. Obviously, you're not up P&L wise if the put is in the money, at least not initially. You are with the call in the money, but those are two okay scenarios based on how we're going to be trading or how we trade this ES collar strategy into perpetuity. It's our main core type of position, something that's dealing with the S&P 500. It can be the SPY, it can be the UPRO, it can be the ES, it can be an MES. But I like the ES the most because of the leverage behind it. And so let me show you what I mean. Let's say it is 3 days to go to expiration and your call is in the money. And let's say your call is like this 79 delta here. And your put is at, let's say, about 100 points lower. So about somewhere around here. Right? So you've made money because your call is deep in the money. It's at a 79.80 delta there. Your put is darn near worthless. It's not worthless because it's 3 days to go, but it's darn near. And so what you would do to close this out, you would do the opposite. You sold the call, so you would buy it. You bought the put, so you would sell it. If you were getting out of the trade, it'd be an overall debit. You're closing the trade out. If you got out of the futures contract as well, that acts as the shares for us. You'll be getting out of those futures contract, and that you run on the trade, it's done. You didn't get the max profit because it's still 3 days to go and your call is only at an 80 delta, but you got close to the max profit. You've made money. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. But let's just say you want to do it the way I primarily do it, and you want to continue the trade. You're just going to move the options. So you're going to do the opposite that we just did and buy it back. And then I'm going to move it out, and I'm going to go to 11 days because I like to go to Friday to Friday. I'm not going to go in the same expiration week Friday. I'm going to go to the Friday after the week that I'm in. So that's why we're going 11 days here. Because I've won on that trade already and I'm treating it as I've taken it completely off, I'm going to treat this 11-day expiration that you guys can see here as a new trade. How would I set up my collar if I was starting with this 11 days to expiration right now? I disregard what's happened before with the 3 days to go because I've already won. That's no disputing that. I've made money. I'm looking at this 11 days now. And so if I'm going to look at this 11 days, I'm going to, for example, sell this because I'm going to look at my assumption. Is my assumption bullish, bearish, what neutral for the next 11 days? Let's say I'm a little bullish. In this example, I'm going to sell the 64.40, which is 40 points higher than where it's currently trading at right now. And then I'm going to buy a put that just say for, instead of going for 36, this I'm going to buy it for 26. So I'm going to buy that put for 26. So basically right here. So I'm buying the put at the 62.90. And then this is where you need to know the basics or the math behind the ES because it's not going to give it to you, especially on a platform like Thinkorswim. It's not going to give you even the small amount of stuff that TastyTrade gives you on this. You have to know the math and you have to do it for yourself. And the faster you are at it, the better. So in this example, I just want to point out a couple of things really fast. We stopped losing now at the 62.90. 3 days 3 days ago, that put was at the 62.25. So we've moved that put closer to at the money. On this new trade, we're getting a credit of about $500 because 10 times 50 is 500. We have a 10-cent difference between the call and the put. That's a $10 difference. 10 times 50 is 500. So we're making 500 on the new trade. That's the credit that we were getting on the new trade. Now, overall, this is a debit of 70.50, let's just say, or 70.75, let's just say, 74.75, let's say. We've moved the call from the 325, the 620, excuse me, the 63.25 to the 64.40. So if we do the math, we take the 64.40 and we minus the 63.25, that is a 115-point difference. Keep that in mind. So if we go here and hit this review, you can see that this trade to readjust it is going to be a debit of $3,700. We collected $500 on the new 11-day expiration. So if I take the difference between where the call is at with 3 days into the new call with 11 days, that's 115 points that we mentioned. We times that by 50. That's going to be 57.50. So for another week, we can make another $2,000, as you guys can see here. We have another $2,000 to the upside just with that part, plus the 500. We have $2,500 we can make over the next week, reposition this trade, even though the call was deep in the money and we all agree that we've won on that already. This is a good thing. We reset the trade. We got less risk to the downside because we moved that put up. It's closer to where the underlining or the stock or the contract, the futures contract is trading at now. And we have more upside over this next 11 days if the S&P continues to go up. This is awesome. Let me talk about the put side, okay? And so the put side is interesting because let's say 3 days ago again, and let's just say the put side is in the money at the 80 delta. It can be more, it can be less, but whatever the case may be, let's say it's at the 80 delta. You bought the put and you sold the call, and let's say the call was 100 points higher, so somewhere around here. So the call is darn near worthless. The put is in the money, right? You've stopped losing once it hit the 64, but you've lost over this week, right? You've lost over the week. There's no disputing that. You've lost over the week, but you have stopped losing once it hit this 64.55. Okay, so now we're going to sell that and we're going to buy this back. That's giving us an overall credit, as you guys can see here, this $74 credit. I'm going to go to 11 days and I'm just going to put it where it's currently at. And that's where I'm going to start at. So I'm going to go to the put side is at the 64.55 and I'm going to buy that. They do not have a 64.55. So I'm going to buy the 64.60. You can go to the 55. I'm just going to use this as an example. And I'm going to buy the 64.60 on the call side. So I'm going to sell the 65.60. I'm just making both of them, like this. And so this is an overall debit of 18. I love it when it happens this way because I won't touch my call because I'm betting that the ES is going to bounce back. You can touch your call, but for me, I'm not going to touch my call. What I'm going to do is just move this put down. And let's say I move it from a 69 to a 59. I now received an overall credit for moving it. And so that's 3 times 50. That's what I'm receiving because it's $50 a point for the ES. I still have no risk to the downside because it's trading up. My put is higher than where it's currently trading at. So I've reduced my overall risk.
But you lost value in that you were already at a loss position. You just didn't lose as much as you could have. And now when you move this farther down, if it doesn't come back up right away,
You don't lose more. That's what I'm saying. You're not going to lose more because you move this, because you're getting an overall credit here. And so you actually lowered your cost basis by, let's say if we receive $3 here, you actually lowered your cost basis by $3 and you can't lose anymore because your put is already in the money. In this scenario, is you lost overall. I'm not saying that you haven't lost overall. Let's say if you first put the trade on last week, Mark, and it's 3 days to go, and your put is in the money at an 80 delta that we were saying, you've lost in that week, no question. What I'm saying is going forward, you're good. If it keeps dropping, you're good. You obviously don't want it to keep dropping, but you're going to be able to move that put in the money each week for a credit. And people like Gordon saw this happen during Liberation Day. It wasn't on the ES, but it's the same concept. It was on stocks, but it's the same concept. You're going to be able to move that put for a credit and you eventually be able to take off the call if you want and just have a protective put. So if something jumps back up in a massive way, you're going to be good to the upside.